Hi, Professor Rex here. In this week's video, I'm going to focus on the simple tech stock portfolio my accounting students and I started in April of 2024 as outlined in red on this slide. I'll also talk about our two new strategies I'm experimenting with, capital light companies and wide-moat stocks, which is a simple way to ensure you're only investing in companies with the strongest competitive advantages. And I'll also talk a little bit about a sector strategy at the very end of the video. If you're interested in the dividend growth stock portfolio on the far left, I've started a completely free Substack featuring that portfolio to see if I like the Substack platform. You can sign up and see which dividend growth stocks we're buying in real time on Mondays. Usually Mondays, unless it's a holiday, then it's a Tuesday. But let's get back to our tech stock portfolio outlined in red on this slide. It's a real-world investment portfolio where I make additional investments on the first trading day of each week. It's by far our most volatile portfolio because it's not diversified since it only invests in one sector, and tech stocks, by their very nature, tend to be very volatile. Also, it's one of our newer portfolios, so its performance will fluctuate up and down more so than our other portfolios, which have far longer track records. Our tech stock portfolio so far has an annualized return of 12.04% versus its benchmark's return of only 4.51%. In next week's video, we'll talk in depth about our dividend stock portfolios that my accounting students I started back in 2022 and 2023 as outlined in yellow. Like our tech stock portfolio, they are real-world investment portfolios where I make additional investments on the first trading day of each week. So in effect, they are accumulation portfolios, mimicking someone in their working years who is consistently adding to their investment portfolios. As a reminder, the portfolios on the right in the light blue outline are portfolios that I started in 2003 when I was in college. These portfolios are more buy and hold portfolios with infrequent trading, so their lack of action might make for boring videos, but you can go online to read more about them if you like less frequent trading. Well, here's a summary of our investment strategies, their annual returns, when they were started, and where you can find them. The dividend strategies are my personal favorite since my goal is to generate passive income that is twice my annual expenses. The dividend growth stock portfolio seems to be the most popular, so I put it on Substack for free as an experiment to see if I like the Substack platform. So far, Substack is easy to use and it's turning out to be more fun than I expected since it has a social aspect to it. You can find the list of dividend growth stocks that we're buying on the first trading day of each week, either on Substack or my website. You can find most of the strategies on my website, beatthestockmarket.com, but if you can't afford it, each week for free I've been detailing the dividend stocks we've been buying in a YouTube video, I should say about every 2 weeks. And then I feature the tech stock portfolio, the wide-moat strategy, and capital light strategy in the next week's video. Now I found that Substack has a notes feature, which are free for anyone to read, and last week I posted a few notes. So go ahead and read about those. If you're interested in that, sign up for free on Substack, and feel free to leave me a comment to let me know to post either the list of capital light stocks we buy each week or the wide-moat stocks we also buy each week as part of our wide-moat strategy. I don't want to make a commitment to posting them each week unless there's some interest in them. Now, so in this green box in the upper left, note that I've added a note that says that these three strategies are newer and therefore the average return has been, or the average investment has been held for less than a year. This means their annualized returns will fluctuate a lot until the holding period eventually grows longer. For example, the capital light strategy is by far the newest strategy as it was started in February of this year. As you can see on this bottom table down here, the average investment in the capital light strategy has only been held for 56.7 days and has a return of 5.5%. The annualized return of 41.19% should be taken with a grain of salt. All that means is if a stock's price increases 5.5% every 56.7 days, the annual return would be 41.19% per year. Will it continue to do that? We'll see. So here's a weekly chart of how our weekly investments into our model portfolio of tech stocks have been growing. It's as of last Friday. Now the recent volatile ride of our tech stock portfolio continues. Now this flat and down areas happened when tariffs were announced, and then this sharp increase occurred when the 90-day pause on the tariffs was announced, and this last dip happened when it was announced that large tariffs will be placed on Europe. Now, during this weekend, the administration announced that the tariffs on Europe will also be paused, and that has the S&P 500 futures looking to be up over 1% on Sunday evening when I'm recording this. So expect the volatility to continue. Hi, Rex here. I should say Professor Rex here. My college accounting students love tech stocks and love using what they learn in my accounting classes to pick stocks to invest in. So on April 29th, 2024, I started depositing $12.50 a week into a brokerage account, and we buy 10 different tech stocks each week. We invest only a small amount each week because I wanted to show my students you don't need much money to start investing. This graph is showing the growth of our tech stock portfolio over time as I invest additional funds each week. We have other portfolios too, including dividend portfolios that I mentioned before. And let's see what's on the next slide. Yeah. Here's a usual disclaimer. This presentation is for informational purposes only and is not a recommendation to buy or sell securities or engage in any investment activity. It's all well and fine to do your own investment research. It's all well and fine to get investment ideas from others, but you always need to do your own investment research. So let's talk about the tech stocks we are buying this week. On this slide are our ratings for the top 15 tech stocks. I posted these rankings to our website today, and the website is beatthestockmarket.com. And we're going to purchase the top 10 stocks. Note that all these stocks are higher quality, meaning they must have a quality rating of B- or better. More on what makes up our quality grade on the next slide. Also note that the ranking system used for these tech stocks may differ from the rankings we use to rate dividend growth stocks, because some tech stocks do not pay dividends. Therefore, in this ranking, we ignore the criteria that involves dividend growth, dividend payout ratio, etc. So our highest rated tech stocks this week are Adobe, Accenture, Analog Devices, Intuit, ASML, Arista Networks, Motorola Solutions, Apple, Salesforce, and good old Microsoft. On this slide, I want to show the components to our quality grade. Quality-wise, we only invest in stocks rated B- or better for this portfolio. So these are the same top-rated 15 tech stocks, just with a different metric shown. So risk is the first quality component. Tech stocks, by their very nature, tend to be riskier than most other sectors. The next quality component is competitive advantage. Obviously, the more competitive advantages a company has, the better investment candidate they are. And part of the competitive advantages grade is the moat, but we also include some other metrics. The next quality component attempts to evaluate the company's management. Our evaluation includes both management's use of capital and general decision making, but also our research dives deep into accounting data to look for red flags in the company's accounting practices, as well as the quality or reliability of their reported profits. And finally, the last quality component is financial health. Remember that the risk rating is comparing these stocks to other stocks, not to other investments like bonds or CDs. Now, one reason why tech companies have been outperforming the market for several decades might be because they tend to require little capital. As a simplified example, if you want to start a software company, you just need a computer and software knowledge. On the other hand, if you want to start manufacturing cars or jets, you're going to need a lot of building, equipment, employees, etc. In other words, a lot of capital, which is very expensive to obtain and maintain. Now, Goldman Sachs recently published a research note that shows that companies that do not require a lot of capital have significantly outperformed companies that employ heavy capital by 544% over the period of 1990 to 2024. The research calculated capital intensity based on three formulas: assets divided by number of employees, assets divided by net income, and capital expenditures divided by net income. After finding this research note, I contacted the authors and discovered we might be able to get even better results, because in the study, they ranked and classified companies based on the 45 sectors of the ICB taxonomy. So they call them sectors, but you can probably think of them more as industries. So they base the results on just the sectors, not on individual companies. Not only did they look only at these 45 sectors, they took the sector's median since 1990. So if the sector's capital intensity changed over the years, they ignored that. The authors admitted that sectors that were once capital light can become capital heavy and vice versa. And they admitted that within a given sector, one company may be capital light while another is capital heavy. But they ignored that too. Now, I'm assuming they did this to save time, because otherwise they would have to look at each individual company's factor for each month or week and then do this for each and every year in the study, which is a lot of work when you're looking back over 30 years. So it seems their study could have had even better results if they dug deeper and looked at companies specifically instead of sectors in general. And we can do this in real time going forward on a weekly basis, and we have been. So that's what we're doing. We're looking at individual companies that are capital light, but also high quality. And our capital light rating is based on individual companies, not whole sectors or industries or sub-industries. Before we look at the companies that are both capital light and high quality, let's look at the list. Let's look at a list of the S&P 500 companies that are considered capital light according to the Goldman Sachs study. Once again, the formulas the Goldman Sachs study used were assets divided by number of employees, assets divided by net income, and capital expenditures divided by net income. And since the study covered a 34-year period when growth outperformed value, on this slide, just for fun, I added our valuation column, which in this case is based solely on a growth methodology instead of our usual combination of two methodologies, one being growth and the other being deep value. Now expect the valuation column to potentially change a lot as companies report earnings. So anytime there's an earnings period, the valuation will change quite a bit as the quarterly earnings report roll in. Let's see. On the next slide, I'll show you which ones we think are the best potential investments at this time and which ones we're actually investing in. So on this slide, I have a list of S&P 500 companies that are capital light, high quality, and appear to be undervalued using a growth methodology. These are also the capital light stocks we're buying today. Similar to our high yield stock portfolio, we're using two strategies for this portfolio. Strategy 1, in red, as you can see over here, emphasizes how undervalued a company is, while strategy 2 in green includes a quality as a factor too, not just how undervalued it is. So you will usually see higher quality companies in strategy 2 as compared to strategy 1. It'll be interesting to see which strategy does better in the long run. So far, the portfolio is ahead of the S&P 500 as we saw earlier in the video, but it's very early using this strategy. So far, the average investment in this portfolio has a 5.5% total return with an average holding period of 56.7 days, which is equivalent to a 41.19% annual return. If we'd instead invested the same amounts in the S&P 500 on the same days, instead of an annualized return of 41%, we'd have an annualized return of 13.8%. So for this slide, I started with a list of over 4,300 companies. And the first step we used to filter out the companies was those 3 capital-intensive formulas that we talked about earlier that the authors used. And then we incorporated our undervalued ranking and our quality grade. So here's a strategy I started tinkering with behind the scenes in September 2023. It's not the most diversified portfolio, so I decided to wait longer to share the results. It's a wide-moat stock strategy. First of all, what is a moat? Well, Morningstar is a service that rates stocks and is famous for its moat rating that it assigns to large companies. Well, so what is a moat rating? A moat rating attempts to simply measure the competitive advantages of a company. Now, if a company has no competitive advantages, then it's very easy for another company to enter the industry and take customers away from that company. They call it a moat rating because they liken it to a moat around a castle. If the moat around the castle is wide, then it's hard to storm that castle. If the moat is narrow, then it's a bit easier to attack the castle. And if there's no moat at all, then the castle is much easier to attack. So this strategy invests only in the companies with the best competitive advantages, in other words, the widest moats. There are limitations to the moat rating, and I prefer my own quality ranking system that takes much more data into consideration, including the moat rating. But the moat rating is kind of a quick shortcut way to invest in only high quality stocks. So on the next slide, you'll see my rating for the top 15 companies with wide moats. But first, let's look at the strategy's performance. Like the tech stock portfolio, I've been making weekly investments into this portfolio. I originally had the strategy in a Fidelity portfolio with a few other strategies, but quickly learned that having several strategies in the same account makes it a nightmare to track their performance separately. So I sold off those holdings and have since started a Fidelity account dedicated solely to this wide moat strategy. The average investment so far has been held for less than a year and has produced a total return of 21.17%. Using Excel's rate function, that's an annual return of 47.63%. And no, it's probably not going to stay that high. Probably will come down over the long run, but we'll see. Now, the strategy does not result in a portfolio with as much diversification as most of our other strategies, so the portfolio's performance could fluctuate a lot, and the performance likely won't stay quite that high since stocks historically average around 10% a year. Now, Morningstar offers an ETF that only invests in Wide-Moat stocks. So that ETF is a natural benchmark for this strategy. Its ticker symbol is MOAT, M-O-A-T. If we'd instead invested in MOAT on the same exact days, we would have received a return of 9.88% with the same holding period. Using Excel's rate function, that's an annual return of 20.95%. So our Wide-Moat strategy has more than doubled the return of the Morningstar ETF. The strategy is also beating the S&P 500 by 15 percentage points on an annualized basis. Now let's look at our ranking for the best Wide-Moat companies as of this weekend, Memorial Day weekend. In other words, the companies with the strongest competitive advantages. These ratings are as of last Friday after the market closed. The valuation methodology used is a growth methodology, not a deep value methodology that we sometimes use. Now, unlike our dividend growth portfolio where we want a lot of diversification, so for the dividend growth portfolio, we buy 10 stocks each week and we stop buying a stock if it makes up 4% or more of the portfolio. But for this portfolio, the Wide-Moat portfolio, we only buy the top 5 stocks each week and we do not limit how much any individual stock can be in the portfolio. So we let our winners run. So this portfolio is way less diversified and more aggressive than our dividend growth stock portfolio. Remember, stocks in any of our strategies may appear on the list one week, but not appear the next week, as they might barely miss a screening criteria such as earnings estimates over the next 12 months, which changes frequently. And just because a stock falls out of the ranking one week rarely means that we plan to sell the stock. Sales tend to be rare. So the 5 companies we bought we are buying today are Arista Networks, Thermo Fisher, Adobe Systems, Eli Lilly, and Salesforce. So Pfizer just barely missed our cutoff of only buying the top 5. Now, one advantage of companies with the best moats is if they pay dividends, they are more likely to increase dividends even during an economic shock when compared to companies with no moat. So on this slide, Morningstar shows their 3 categories of moats. On top, we have the companies with wide moats, which is considered the best. On the bottom, we've got no moats, and in the middle, we've got narrow moats. This slide shows that during the 3-year COVID period, when supply chains ground to a halt and some companies saw a collapse in sales, about 80% of wide moat companies were able to raise their dividends despite many companies being in financial trouble. Only 18% or so cut their dividends. For companies with no moat, which is on the bottom of the chart, only 57% or so were able to raise their dividends, while over 30% were forced to cut their dividends. For that reason, many of our strategies only invest in companies with either a wide or narrow moat. While our quality ranking for stocks includes moats, it goes much deeper than just one metric. But if you want a simple metric for quality, moats are a good place to start. Of course, this slide only covers a 3-year COVID period. During normal periods, dividend cuts are much more rare, and on average, companies increase their dividends 5.5% to 6% per year. Now, I had planned on introducing a sector strategy that reportedly has beaten the market by over 4.4 percentage points per year, but I've run out of time on this Memorial Day weekend. So the next time we do a video about tech stocks, capital light stocks, and wide-moat stocks, I'll talk more about this strategy and how an investor could potentially use it to tilt their portfolio more towards certain sectors in order to squeeze some additional return out of their portfolio. Or if you're an aggressive investor, you could just invest in the sectors that are considered overweight at a certain time. But more on that in a future video. So in the comments, let me know if you have any questions. Also, let me know what portfolios or investment strategies you'd like to see more of. And finally, here are the places you can reach me. YouTube, obviously, as well as our website, beatthestockmarket.com, LinkedIn, Twitter, and now Substack. I'll see you again next week, likely with a list of dividend stocks we'll have purchased this week. See ya!